As Canada's financial regulator gives banks more time to adjust to stricter capital requirements, we find ourselves at a crossroads. The path we take will shape the future resilience and competitiveness of our nation's banking sector for years to come. The reforms in question are part of the Basel III Accords, a global effort to fortify banks against future financial shocks. At their core is the capital floor, a standardized model for calculating lending risks that aims to ensure banks don't dangerously underestimate potential losses through their internal risk models. This push for more conservative capitalization is understandable given the sins of the past. The 2008 crisis exposed how banks had become overextended, their reserves woefully inadequate buffers against seismic economic disruptions. The new rules are meant to inoculate the system against such catastrophic misjudgments. And yet, prudence must be balanced against other vital societal needs. As Ottawa delays the final phase of these reforms by a year, it provides a welcome opportunity to carefully consider the trade-offs and get the calibration right. For one, these heightened capital requirements could significantly curb bank lending at a pivotal moment for the Canadian economy. As households grapple with elevated unemployment and higher borrowing costs, starving the recovery of credit would be counterproductive. Economic experts warn the original implementation timeline could reduce overall lending by as much as 9% of GDP at a time when capital is sorely needed to fuel investment and growth. There are also concerns about the impact on competition and access to credit, particularly for smaller businesses and individual borrowers. If the capital bar is set too high, it could price out some community lenders and leave underserved segments cut off from vital financing streams. The U.S. implementation has already sparked an intense lobbying battle, with banks there arguing the reforms could make mortgages and business loans prohibitively expensive. While criticism from lenders with vested interests must always be taken with a grain of salt, the Trump administration's hesitance highlights the need to get this recalibration right. To their credit, Canada's banks have generally been well capitalized, with robust risk management practices honed over decades of relative stability. Unlike their American cousins pre-crisis, they did not overindulge in the riskiest mortgage-backed securities and derivatives trades that turned toxic. This stronger starting position is why our nation led the way on implementing Basel III. But keeping ahead of the curve shouldn't come at the expense of economic vitality. As Ottawa rightly pauses to assess the reforms unfolding south of the border, it must thoughtfully weigh protecting the system's resilience with sustaining the lending critical to job creation and productivity growth. The financial sector's role is not just avoiding crises, but efficiently allocating capital to its highest value uses. An overly draconian capital regime could strangle that vital function, ossifying the industry and constraining dynamism over the long run. So as politicians and regulators work through the final details, they must strive to achieve that elusive golden mean. The path forward should enhance stability while preserving the nimbleness and innovative spirit that has allowed Canadian banking to thrive. Some tightening of oversight is necessary to buffer against future shocks. But dogmatic adherence to inflexible international rules would be as financially stultifying as the imprudent practices that necessitated reform in the first place. A balanced, tailored approach attuned to our economic realities and banking sector's historic strengths is the prudent way to robustly secure prosperity. For as we embark on this new regulatory trail, we must never lose sight of the true path to national wealth, nurturing a vibrant ecosystem of prudent risk-taking and productive investment. Striking that delicate balance is the great challenge ahead. With judicious foresight, Canada can fortify its financial core while keeping economic verve flowing through its institutional arteries.